This is Ethan, CFA Charterholder and investment professional, and today I'm going to cover the top 4 mistakes people make with SCHD based on the hundreds of comments we've gotten on our 3 videos that covered it. Each of these is in the context of SCHD, but actually will lead to valuable investment insights and lessons that will last you a lifetime, whether you're invested in SCHD or not. Let's dive in. If oil is projected to stay low and interest rates relatively high, SCHD will continue to decline. This comment comes from a video where I explained why SCHD had fallen for 12 out of the prior 13 days. One of the reasons was that it held a lot of oil stocks, and that the market was starting to predict an increase in oil supply, which led to a fall in projected future oil prices, and thus a drop in the stock prices of oil companies. Another reason was that it owned a lot of regional banks, which were hurt because the expectations for higher inflation and fewer rate cuts had pushed up long-term interest rates, from the red line on November 29th to the blue line on December 19th. This leads me to one of the most important investment lessons you could ever learn. Everything that's expected to happen in the stock and bond markets is already priced in. So going back to the comment, if oil is projected to stay low and interest rates relatively high, will SCHD continue to decline? Actually, no, because what's expected to happen is already priced in. Those changing expectations for lower oil prices and higher rates in the future were the 2 biggest reasons that SCHD fell in the past, over that specific period. But now, those new future oil price and interest rate expectations are already priced into the current stock prices. So the only thing that will matter for the future stock price moves is how expectations for interest rates and oil prices will change in the future. Only if oil prices are expected to go even lower or interest rates are expected to go even higher than they are now would it cause SCHD to fall further. Obviously, there are other things that impact the prices of the stocks in SCHD, but with respect to these 2 specific areas, it's only the future movements that will impact the future stock price changes. The next one is about selling what's been going down and buying what's been going up. Douglas Michael makes a great point about people who go overboard in thinking that the trend is my friend. Here's an example. This person is selling their SCHD to move into crypto, then plans to take out their big gains that they think they're sure to get and put them back into SCHD for safety. It doesn't have to be crypto, though. It could be anything. Tech stocks or whatever has been hot lately, this lesson will apply. Actually, it has a lot to do with the last one. Investing is very emotional because our money is our livelihood. The main emotions that drive our investment decisions are fear and greed. And since we fear losing money, we often want to sell when things are down, and since we get FOMO when we see other people making a lot of money, it's tempting to rush in and get our own piece of the pie. It sounds totally logical, but unfortunately, that is a terrible way to invest. Markets are cyclical, and emotions drive stock prices. The more positive they are, the higher the price goes, and vice versa. But remember, stock prices are always pricing in future expectations, so the higher the price goes, the better the future has to be just to justify the current prices. If things turn out to be just good, not great, but people thought that they would be great, the stock price will go back down. That's why you can see headlines where companies grow their earnings by 20%, but then the stock price still falls. Because if investors thought they were going to grow their earnings by 30%, but then they only grew them by 20%, that's worse than the expectations that were already priced in. So when will SCHD stop falling, and when will crypto or hot AI stocks stop rising? I can't give you the exact day, but I can tell you that the higher expectations are, the harder they are to meet, and the more likely it is that the future will disappoint, and vice versa when prices are low. That's why it's better to buy when things are low and sell when things are high. Many people in our comments said they were buying the dip in SCHD, and while I think it is better to simply not react at all to short-term moves, if you are going to do that, buying low is certainly better than buying high, in my opinion. Lots of people also said things along the lines of, the income stream is more important than the price appreciation. Actually, even for an income investor, the income stream should be completely irrelevant, and the only things that should matter are price appreciation, volatility, and taxes. For a very simple example, let's imagine one ETF pays a consistent 5% yield, but its price goes down 10% every year. Let's say in year 1, you get 5% of your $100,000 investment, so $5,000 of income. But then the next year, it's 5% of $90,000, or only $4,500 of income. Then 5% of $81,000, and so forth and so on. Even if the yield stays the same, the yield is just a percentage of the NAV. So if the NAV is falling, your income will be falling. Conversely, let's say you've got an investment that pays no dividends at all, but goes up 10% per year. Well, even if it doesn't pay a dividend, you can still take money out of your account and create your own income stream, right? So if it goes from 100,000 to 110,000, you can take out 5% income and still have money left over. If it grows 10% again the next year, you can take out another 5% income stream, but now it'll actually be higher than the income payment you got the year before. Put simply, if there's money in your account, you can create an income stream. If there's not, you can't. Simple as that. My preferred method for retirement income is to focus on building a diversified portfolio that will provide a solid, long-term upside potential with limited volatility, and then creating a systematic withdrawal plan. That means that regardless of what your investments return, and regardless of how many dividends they pay, you still just reinvest everything and then set your account up to withdraw the same amount each month as if you were still working and getting a regular paycheck. Then your income is consistent and you don't have to worry about short-term moves in your investments or monthly dividend increases or decreases. Set it and forget it. And you can set it to increase your income each year with whatever inflation was. That is hands down the best way to reduce your stress and create a solid, sustainable, long-term income stream through retirement, in my opinion. The next mistake is thinking dividends compete with interest rates, or people will sell dividend stocks to buy bonds when interest rates rise, or sell bonds to buy dividend stocks when interest rates fall. We've gotten many comments along these lines. This is also related to the last one, focusing too much on the income. Yes, all else equal, a 4% yield is more attractive than a 3% yield, and a 2% yield is less attractive than a 3% yield. But all else is definitely not equal in this case. Stocks offer significant long-term upside potential. Bonds do not. Stocks have significant short-term volatility and downside risk. Most treasury bonds do not. Certainly not money market funds. So no investor should really ever be deciding between stocks and treasury bonds based on yield. That's like deciding whether you should drive across the country or fly across the country based on the number of cup holders. It maybe could make a small difference, but it should never be the deciding factor. A vastly bigger difference in your long-term outcome will be from the fact that stocks and bonds behave very differently in both the short and the long term. If you enjoyed this video, hit that like button, leave a comment with what you'd like us to cover next, and be sure to subscribe so you won't miss it. And if you want to continue the investment conversation with my partner Kyle and I, you can click the link in the description and join our Discord, which is free as I'm recording this, but may not stay that way forever. Thank you for watching, and I'll see you in the next video.